Welcome back to the channel, everyone. On today's video, we will be discussing the Schwab US Dividend Equity ETF. It seems to be very popular among dividend investors, especially dividend investors here on the Canadian side. It trades under ticker symbol SCHD, and it obviously trades in US dollars as the holdings are all American based. Now, if we take a look here on the chart, over the past year, it's up 3.9%. This is not inclusive of dividends. It currently has a dividend yield of 3.8%. So we're looking at a 7% return for 1 year, which is pretty decent. It's around market. So there's nothing to complain about there. But I don't particularly like this ETF, and we're going to get into why in a moment. But first, I want to talk about a few of the positives. Number one is the expense ratio. It's only at 0.06%. This is very, very low. And if you take into account that you get 104 holdings, I think that is super reasonable. So a reason why I like this is, on the Canadian side, it's hard for us to buy a bunch of US-based equities because of, paying $10 US per trade, as well as the conversion fees all the time. So this is nice that you can just buy this one basket of holdings and you kind of get it done and over with. So I kind of like that, but that's not inclusive to SCHD. That's kind of all American-based ETFs, but it is a positive. The second positive is the yield. It's fairly high at 3.8%. So we don't have a lot of low dividend payers in this holding, in this ETF holding. 3.8% is fairly high, and we're about to take a look at the stocks in the portfolio. Now, if we take a look at the holdings from the highest percentage down low, we're going to see Broadcom as number one, which is a great company, PepsiCo, Cisco Systems, Home Depot. So, if you take a look at these stocks, you can go from the top to the bottom and you can determine that, you like most of them, maybe not every single one. Like Altria is pretty high up there at 2.47%. I don't want Altria as that high a percentage of my portfolio. I understand that it pays an 8% dividend right now. Kimberly-Clark's another kind of dead weight US-based stock, in my opinion, with a just over 3% yield. I don't particularly want that. 3M is just faced with a litany of litigation issues right now. It's popped up slightly as of late, but this is one I wouldn't hold under any circumstance because of all the lawsuits facing it. So, these are the reasons I don't love buying ETFs. You get the good and the bad, and even the top holding here, Broadcom, this is a great company, absolutely, but it's on such a hot streak right now. They just signed a deal with Apple to make a bunch of chips in the US with them, and this thing has just been popping. It went from $500 to $800 a share, right? So I wouldn't buy Broadcom as an individual holding right now because it's, I think, valued way too highly for my blood. So why would I buy it in an ETF where it's the top holding, right? But we have Home Depot here at 4% of the portfolio. It's trading around $300 a share right now. This is a huge buy in my opinion, and they increased the dividend 10% pretty much year over year. So this ETF portfolio is not for me. I can see why it's popular. You get a little taste of everything on the American side, but I don't want some of these companies at the price they're trading at now. Other companies like Pfizer, for example, I don't like this one at all, so I wouldn't want to own this. It's just too big of a basket for me with amazing companies and poorly run companies. So, I definitely don't want to buy Best Buy, all right? So if you're going to buy this SCHD ETF, take a look at all the holdings, okay? And ask yourself, would you buy these holdings individually? Would you own H&R Block in your own portfolio if you had to buy it yourself? Usually the answer is no, right? So don't just look at the yield, guys. Take a look at all the holdings, and if you decide it's for you, I think that's great. It's just not for me for the reasons that I've disclosed. One thing that I will say is that SCHD is fairly well diversified. Take a look here at financials. All our Canadian ETFs are very, very heavy financials. Well, most of them, I should say, because banking and insurance are huge sectors for us. If you take a look, it's only 14% of SCHD. So that's a way to get different type of exposure, and the healthcare at 16%. Like I said, I don't like the Pfizer aspect of it, but it does give you access to a wide variety of American sectors, and it's just different companies than we have here in Canada. So these are all the reasons it's not for me, but I don't hate it. There are some positives. I said some good things about it as well. Let me know what you guys think of this fund, and I'll see you in the next video.